be narrating the summary of the 5 rules for successful stock investing by Pat Dorsey. Introduction. The investment business might seem a little tricky to a rookie. There are so many industries and so many companies. When should you buy and when should you sell? If all these questions bother you and keep you from investing, then you should read this book and change your outlook on investing. This book teaches you how to ensure your investments are safe, risk-free, and have the maximum returns. Whether it's the food industry, bank, or any consumer service, now you'll know what kind of companies should you look for and what risk factors you must assess. Chapters 1, 2, and 3. The 5 rules of successful stock investing, 7 mistakes to avoid, economic moats. Your investment strategies must remain the same. You must develop a great plan and stick to it throughout. Without further ado, here are the 5 rules we recommend you to successfully invest. Number 1. Do your homework. This might seem a little obvious, but not many people do their homework right. Unless you know the business you're purchasing, don't buy it. If you're putting your money in it, you should know what you're buying. This will require quite some effort and time. You'll need to sit down and look at the financial reports and find out who your competitors are. Number 2. Find economic moats. The term economic moat means an advantage a company has over the other. This helps you to know why a company is better than the other. Identifying which companies have economic moats is a critical part of investing. Number 3. Have a margin of safety. Finding the right company is only half the job. The company should also be sold at a great price. If you purchase every great company, even if they are overvalued, your returns aren't going to be great. Take Coke, for example. Everyone knows it's a great company to invest. It would have been even better if you would have invested back in the 1990s. But people who have paid 50 times the amount of Coke's earnings are not happy with its returns. This is because they forgot to have a margin of safety. The margin of safety ensures that even if you overestimated the value of a company, you will have a cushion that will make sure you suffer no losses. Number 4. Hold for the long haul. Do you buy your car and immediately sell it? Do you buy a CD or a refrigerator and then sell it? No. Then why should you buy and immediately sell your stocks? Short-term costs are expensive. You have to pay taxes and the stockbrokers. If you trade frequently, your expenses might overcome your returns. Number 5. Know when to sell. As necessary as it is to know when to buy, it's also crucial to know when to sell. Rather than monitoring the stocks you own, monitor the companies. Don't look at the stock prices 20 times a day. Keep a look at how the companies are doing and the industry in which they function. Before diving into the company analysis, let's have a quick look at 7 mistakes that you can easily avoid. Number 1. Swinging for the fences. If your portfolio contains risky stocks, you'll be swinging for the fences. This goes back to our earlier rule, find the economic moats. Number 2. Believing that it's different this time. History does repeat itself, even in the stock market. For example, in 2000, the financial press began writing that semiconductor stocks were no longer a good business. But a year later, energy stocks were soaring high. But when the economy slowed, they went bankrupt. To summarize, you have to understand the market's history to be able to understand its future. And whenever someone says it's different this time, don't believe them. Number 3. Fall in love with products. A lot of people fall into this trap. Just because you like the product doesn't mean it's going to be a great one. Great products do not always translate into outstanding profits. Number 4. Panicking when the market is down. Stocks are more attractive when no one else is buying them. That is your time to shine, not to panic. Number 5. Trying to time the market. No strategy can help you know when it is to be great in the market and when it is good to be out of it. Number 6. Ignoring valuation. You could have made a ton of money in Yahoo during the internet bubble, but only if you would have gotten out in time. But how certain are you that you would have? The value of a company and its price are two different things. Number 7. Relying on earnings for the whole story. Earnings aren't as essential as cash flow. The statement of cash flow can tell you about the actual health of a business. Now we are ready to assess a company and find out its economic moat. To do that, just follow these 4 simple steps. Step number 1, evaluate profitability. To calculate a company's profitability, you must see how much cash flow it's generating. You must find out what the returns on assets are. You can compare a company's performance with another company to evaluate how much profit it's gaining. Step number 2, building an economic moat. Now that you have assessed the profitability, you need to know why the company has gained those profits. Find out why other companies aren't able to steal their customers. Step number 3, how long will it last? Once we've built an economic moat, now we have to figure out how long will the company be able to keep its competition away. Step number 4, industry analysis. When all these steps are completed, analyze the industry in which the company operates. You don't have to do a detailed analysis, but just glance over the sales and earnings of various companies in the industry. Chapters 4, 5, and 6. The language of investing. 3 simple statements are going to make the investment business easier for you. Balance sheet, income statement, and statement of cash flows. The balance sheet is a company's credit report. It tells you how much a company owns assets relative to what it owes liabilities. The income statement tells you how much the company made or lost in accounting profits during a year. Unlike the balance sheet, this record is set over some time. The cash flow statement records all the cash that flows into the company and flows out of the company. So what's the difference between the income statement and the cash flow statement? Let's take an example to understand this. Suppose Colgate sells a few cases of toothpaste to Joe's corner store for $1,000. Joe is given 60 days to pay because he's a regular customer and has a good history of paying on time. Next month comes along and Joe hasn't paid yet, but Colgate closes its book for the quarter. Colgate's income statement will show $1,000 in sales. But because Joe hasn't paid yet, the balance sheet will include an entry mentioning Joe owes $1,000. So coming back to the balance sheet, it records the assets and liabilities. It also records the equities that are nothing but the difference in assets and liabilities. You need to keep an eye on sales and revenue. If the income statement mentions sales that haven't been paid yet, it's a sign of trouble. Now that you're equipped with the knowledge of financial statements, you can analyze the company. Analyzing the company can be a little daunting, so let's divide the process into 5 stages. Number 1, growth. How fast has the company grown and what are its sources? Growth leads people to temptations. The past growth rate may or may not continue in the future. You cannot keep looking at previous growth and predict the future. Growth usually stems from 4 things: selling more goods or services, raising prices, selling new goods or services, buying another company. Number 2, analysis. What kind of returns does the company generate? How much profit is the company making relative to its investments? The strategy is how you're going to separate great companies from average ones. You can compare the company's cash flow to reported earnings to find out their actual profits. Number 3, financial health. Once we have found out why the company is gaining profits, we need to look at its financial health. It's essential to know if the company has a solid foundation or not. It's not a good sign if the company is drowning in debts. Number 4, the bear case. Look at all that could go wrong with the company. Analyze all its negative aspects. This will also help you to look for troubles in advance in case you decide to purchase their shares. Chapters 7, 8, and 9. The 5th stage needs more analysis and explanation. The 5th stage is excellent management. Why it's important is because it can differentiate between a mediocre business and an outstanding one. You have to find companies in which managers act like stakeholders. They treat it like they own a piece of it. This stage is so crucial that we are going to further divide it into 3 parts. Part number 1, compensation. A single document called the proxy statement can tell you everything you need to know. First, check how much does the management pay itself. Big bonuses are better than big base salaries because that means the money is less likely at risk. Make sure that the company executives are not paid too much. Check out how much the competing firms' CEOs are paid to know if the amount is too much. Part number 2. Character. After checking out the compensation, you have to look at the company's management's character. Are they using their position to enrich their family and friends? Does the board of directors include management's family members? If you find out the company is paying too much to an interior designer firm run by the CEO's wife, take notice. Part number 3. Running the business. Apart from having managers who are paid reasonably well and are honest, they must also know how to run the business. Find out if the company faces any problem and promises a solution. Does it implement it? If the company is hiding something from you or saying they don't disclose any sort of information, the company could be in trouble. You must look out for serious red flags like declining cash flow. An example of this is the company Lucent. Until 1999, its income soared to almost $3.5 billion. However, cash flow was decreasing alarmingly. That was because Lucent was booking innumerable sales without actually receiving the cash. It also kept building its inventory and didn't realize that storing costs also added up. Chapters 10, 11, and 12. Valuation. Intrinsic value. Different ratios cannot tell the actual value of the company, and it's essential to know how much a stock is worth before you decide to pay for it. This is where intrinsic value comes into the picture. It keeps you focused on the value of the business and not the price of the stock. So what is a stock worth? The answer was given by an economist, Irving Fisher, more than 60 years ago. The value of the stock is equal to the present value of its future cash flows. Confused? When companies earn profits, some of it is used to pay expenses and some are used to reinvest in the business. Whatever is left is free cash flow. One thing you must remember is that future cash flow is worth less than present cash flow. Why is that? It's because the money we receive today can be invested. The money we receive in the future cannot be invested now. Time has value. Secondly, there's also a risk that we might never receive the cash flow in the future. For example, you asked your boss for a 1-week vacation, but he asked you to postpone it for a year. To compensate for the delay, instead of 7, you must ask for 8 days of vacation. You should do the same while investing. Now we are going to analyze a company and put everything we learned together. We'll read about Advanced Micro Devices, AMD, a company that manufactures microprocessors. First, we'll look for the economic moat. In the early 1990s, free cash flow turned negative as the company increased its expenditure in reinvesting. That's not a great sign. However, several companies generate negative cash flow before building their economic moat. Overall, there's not much evidence to prove they have a great economic moat. The revenue growth has not been terrible, but isn't great either. The financial health isn't very promising either. At the end of 2002, the company had a debt of $1.9 billion. Looking at the management, the outgoing CEO, Jerry Sanders, had a salary of $1 million every year. All top executives had amazing salaries. Overall, the management looks overpaid. Coming to valuation, AMD has lost money for the past 2 years. To conclude, the stock is very volatile and seems like a bad long-term investment. So now we have applied everything we learned to a company and understood whether we should invest in it or not. Chapters 13, 14 and 15. Healthcare is directly linked to human survival. That is why this sector is expected to help us receive above-average returns. In terms of economic moats, these companies must have high startup costs and patent protection. This will help the company to avoid competition. Pharmaceutical companies are quite attractive. These help you receive high returns. Companies that develop drugs cannot be trusted too much. These do not guarantee a good return, as developing drugs is time-consuming and may not be successful always. Biotechnology startups can be profitable, but you should not invest in these unless you have good knowledge about what the company does. Only invest if you understand this market. The medical device industry is also an area you should be looking at. But you must keep your eye on the government and see if they are introducing any changes in healthcare plans that might affect your business. Companies belonging to the consumer services sector are often those that we see every day. We shop at their stores and eat their food. These include stores like Target, Gap, McDonald's, and so on. The consumer service sector has developed quite a lot in the past few years. The restaurant industry can be split into quick service restaurants and full service restaurants. QSR customers visit the counter where they pay for and receive their meals. Full-service restaurants have waiters that go to the customer's table who place orders. Eating food prepared at restaurants has become quite popular nowadays. But most restaurants do not remain as popular as they are at their peak. Eventually, most restaurants decline. It's difficult for restaurant chains to become as successful as McDonald's or KFC. Most consumer service sector companies witness an aggressive growth that fails in the long run. Look for companies that have established consumer loyalty. Make sure to compare the companies with their competitors. Chapters 16, 17, and 18. Business services include waste management, advertising, airlines. Broadly, these can be classified into three types: technology-based, people-based, and hard asset-based. In business services, the size of the company matters. Numerous business companies have a monopoly on the industry, and it's hard for new players to enter the market. Technology-based companies include data processors and database providers. When these companies become cheap, they are a great opportunity. People-based companies rely on people for their services, such as consultants or advisors. These companies can be attractive at certain times, but are generally less attractive than technology-based companies. And the third kind, hard asset-based industries, depend on huge investments. These include airlines and waste management companies. Usually, airlines have shown a terrible performance. There are only very few companies that are promising in the sector. Whenever you find a company, try to categorize it into one of the three types. Look for its scale and its revenue. Focus on the cash flow. And finally, examine the growth expectations. If the growth rates seem to be unrealistic, do not purchase the stock. Similarly, if you want to invest in banks, you can categorize the companies into three types based on risks: credit, liquidity, and interest rate. Credit risk is the loss resulting from a borrower's failure to repay a loan. Liquidity risk is when a company fails to meet its short-term debt obligations. And finally, interest rate risk is the potential threat that can change the interest rates, and because of that, the value of a bond may change. So depending on the type of risk, find out if it's a good idea to invest. Well-run banks should show steady net income growth. Chapters 19, 20, and 21. The software industry is quite competitive. Creation costs are soaring high, but production costs are extremely low as they are delivered over the internet for almost free. Software companies based on an operating system include Windows and Linux. Microsoft Windows runs on more than 90% of the world's PCs. Linux has slowly become more popular among several servers, but struggled to make money as many distributions are sold free on the internet. The database sector is dominated by Oracle, IBM, and Microsoft. Oracle has superior technology, but IBM and Microsoft have great prices. The video game sector is dominated by Electronic Arts. But you should look for companies that have excellent growth prospects. Do not look for superior technology. It is not sustainable. Looking for economic moats is even more difficult in the hardware sector. If you have ever bought a PC, you should know that it won't take long before a faster PC comes out at a lesser price. Rivalry among producers is threatening. You should look for low-cost companies like Dell. Any company that has a competitive advantage over its rivals should help you receive above-average returns. The media sector is an outstanding opportunity for long-term investors. Look for those companies that consistently generate good cash flow. Look out for their balance sheets and ensure there's no risk. Do not chase hits. If you purchase stock only because of a hit movie or because there's a lot of buzz going around it, it will not pay you off. Chapters 22 and 23. The telecom sector doesn't look very promising. The companies usually have mediocre returns, and their economic moats are nearly non-existent. But the telecom sector will not look the same in the future. The future will be shaped by technological changes, which are also one of the reasons why the telecom sector has a lot of competition. It's crucial to keep an eye on the resources that thrive in the company. Telecom is a capital-intensive business. It's also necessary to keep a check on debts, as often companies with debts exceed their capital. The telecom sector doesn't look very promising. The companies usually have mediocre returns, and their economic moats are nearly non-existent. But the telecom sector will not look the same in the future. The future will be shaped by technological changes, which are also one of the reasons why the telecom sector has a lot of competition. It's crucial to keep an eye on the resources that thrive in the company. Telecom is a capital-intensive business. It's also necessary to keep a check on debts, as often companies with debts exceed their capital while building networks. Telecom carriers continue to compete primarily on price, which also needs monitoring. Finally, consumer goods are a great potential investment opportunity. Just open your refrigerator or your bathroom drawers and you'll find plenty of consumer goods. This industry is composed of food, beverage, household and personal product industries. This industry doesn't grow faster than the general economy, yet the industry can help you receive outstanding returns. If you want to invest in such industries, then look for those that have a cost advantage over their competitors. Look for those firms that consistently launch great products. Check if the company is advertising its products well. Ensure that the cash flow is used cautiously. But to get the best returns and avoid any risks, make sure you have a 20 to 30% margin of safety. Conclusion: investing just doesn't come to you if you don't at least give it a little research. Unless you know how to avoid risks, you'll be in a gamble. That is why this book is essential to read for any investor. It teaches you about the various industry and the risk factors associated with all of them. This book explains to you when you should purchase and when you should sell. You're now made familiar with every type of company and how to avoid all sorts of risks. Now you're ready to invest. Do you think you're closer to understanding investment in stocks after listening to this summary? Let us know in the comments below. Jai Hind.